All right. This is a quick example of illustration with Lafayette Life Insurance Company, a highly rated company when dealing with whole life participating policy, uh, i.e., infinite banking or becoming your own bank, or some may call it a personal reserve account or a secret account. Lafayette is a great company. It's been in business for over 130 years and hasn't missed a dividend payment since its existence. Of course, we're not selling you the dividend in this video. However, we will sell you the performance of this product. Whole life participating is different from whole life traditional and IULs. And if you want to know more about IULs, I have another video regarding IULs. If you'd like for me to share that, contact me and I will provide that to you. Well, this is just a quick example of a illustration with a 50-50 split, which means that 50 is going to the base of the life insurance. Base is the death benefit, and 50% is going towards the LPUA, which is meaning the level paid up addition. A long version for the short version of the cash value side. When I say 50-50 or base LPUA split, meaning 50% of your premium potentially goes to your um, death benefit life insurance costs, and the other 50% goes to the cash value side of it. So here I have a 35-year-old Mr. Training Day. As you see here, he has a $250 premium. You might be like, well, that's a pretty high premium for a death benefit of $31,000. Well, it's a reason to the madness, right? All right, so we have a $3,000 premium annually, which broken down monthly is $250 a month, and we did that by adding a 30-year term to the policy, which is a ride-on or add-on to the policy that actually gives you more death benefit for an extended period of time, 30 years. So, Mr. Training Day has the ability to add to this policy without alerting the IRS 23, almost $24,000 every year at its discretion. Of course, $3,000 of that 23,000 is mandatory, which is the premium, but the remaining 20,000 is discretionary. But he's able to do this for that 30 years right here. Reason why we added a 30-year term rider, which gives you more death benefit, so you are able to add more cash into this policy for this amount of time without alerting the IRS, actually called the MEC limit, modified down the contract. Because if you do alert the IRS, what typically happens is that overage amounts can be taxed. Okay. So hopefully I'm not going too fast or confusing you guys with the information. So he has the discretion to do an additional 20,000 a year for 30 years. And let me go down here and show you something very quick. And this is again a 50-50 split. And that 50-50 is pertaining to his premium, not his cash value. That additional 20,000 has nothing to do with that 50-50 split. That the additional 20,000 has more to do with being able to add that discretionary at his own pace when he wants to into this policy for the 30 years. And again, the reason why we added that 30-year term rider, so he can do that, because the IRS says the more death you have or the more death benefits you have, the more you're able to add cash into this policy without mecking the policy, right? So you see, again, he has a $250 premium with a $31,000 death benefit. But by adding that 30-year term rider, it jumps to $384,000 that year. Okay. And out of that $3,000 premium, he has the ability of a net cash value of $1,249, which we typically say don't touch no more than 85% of that, right? And he has included at $12.49 a $364 dividend annually. Again, as I told you, this company has yet to miss an annual dividend payment. Typically, dividends are paid out around 5%, but they can range anywhere from 4 to 8%, depending on the performance of the company and interest rates that's going on in today's economy, and a lot of variables at play in this. And I'm not here to give you no insurance class, just kind of give you that basic understanding so you can see the differences. So this is a 35-year-old man by the name of Training Day, a $250 monthly premium, $3,000 a year, $31,000 death benefit day one. But soon as that policy is issued with a 30-year term rider added, it's $384,000. And it increases, of course. It's increasing because, of course, that cash value is becoming part of your death benefit as well. Next year, he's contributed $6,000 and he has a $3,000 net cash value, the actual cash he can access, which includes a $451 dividend. All right. Let's say, as you can see, he didn't add the $20,000, none in these years here. And I can show you an example what it would look like if he did add the 20,000. But let's just say for purposes, he's not able to do that. Let's just say he just sticking to the normal $3,000 for 10 years here. 10 years, he's contributed 30,000. He's able to access up to $23,000. He has a $418,000 death benefit with a $1,317 dividend check, which he gets annually. And let's just say he needed to borrow money from this side here. He needed to borrow maybe $3,000. Well, the next year, his balance will still continue to grow. And it'll be an estimated of $26,000 the next following year with a $1,401 dividend. And this amount will still grow as if he never touched that $3,000. Okay. It's one of the bonuses of having a whole life participating policy is where even though you touched a cash value, your policy will still grow as if you never touched it. All right. This is with the Rothschilds and the Rockefellers and the Jim Harbaughs. He was with the Michigan Wolverines. I think he's with the Chargers now. And JFK, his family, J.C. Penney, the Clintons, etc. They all use this kind of policy to grow wealth. All right. So this is just a very, very quick example of how this works. 20 years, say 20 years, he's only able to do the $3,000, which typically people will actually take advantage of being able to do additional 20,000 a year in this policy. And the next video, I will show you what that looks like. But here he does 3,000 in 20 years. That's $60,000. Have the ability to access $62,000. Again, try not to take no more than 85% of this. Typically, 87 is the most, but 85% we tell you. And he has a $2,340 dividend, almost as close to enough where it's like a wash almost in a sense. Typically, it's more of a wash by year 25 because that $3,000 annual premium, he has enough in dividends. If he wanted to put back inside of his policy to help pay for his premium, he could. But this is free money here. That dividend is money that you can use for, whatever it is you need to use it for, which is one of the greatest bonuses of having a whole life participating policy compared to the other policies, such as the IULs that do not pay you a dividend. A term that, of course, absolutely doesn't pay you a dividend, and you get most of none of that money back unless it's ROP. But even with the ROP, which is return of principal kind of term, you get no interest on that money. So as inflation increases, I mean, that dollar that you believe you'll be getting back at the end of the term, it's not going to be the same dollar it once was 30 years ago. So we don't recommend term ROP unless you have a mortgage. But even then, why get it if you can get something like this and have your money work for itself? Typically you put your money in a bank account and you take it out, the balance decreases. You don't really get much interest on that money, and you pay it to the next person. Your money is no longer working for itself anymore. It's not making the money that it could make, the potential interest, the opportunity to have interest in dividends. It's not making that money anymore. So why not use this as your bank, right? Or even a debt eliminator. We do have a recapture reallocation strategy in which we use this kind of policy as a tool to show individuals how to get rid of their debts 2 to 3 times faster than the conventional methods. For example, you can get rid of a mortgage, 30-year mortgage in 15 years, maybe, or 20 years. A car note, that's a 5-year car note, maybe in 2 years. Credit cards, a lot faster. And our next video will definitely break that down as well in our next videos. So again, this is a very, very quick breakdown. This is not a, where I got to break down every nook and cranny of it, but it's very basic. Whole life participating policies are very low in fees, unlike IULs that can range 2, 3, or 4%. This typically has a $120 fee compared to 2, 3, or 4% with an IUL. No taxes, of course, unless you go over your MEC limit, in which we discussed. You cannot go over that amount that was set at $23,696. I think it was. You cannot go over that amount. Uh, 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 it hedges against inflation. Mostly these kinds of products last and survive every Great Depression and a recession on demand. In that worst case scenario, the guaranteed side, if the company went complete bankrupt, this is what you'll get in return uh, as a cash value if the company did terrible, right? Which is still great because you still have a death benefit. You may not get the biggest cash return, but you still get some cash. And the non-guaranteed, you said, well, I thought it was guaranteed. Well, this is because again, it ranges from 4 to 8%. So we can't typically tell you what you'll get back, but we know, with companies like this, it's always between that 4 to 8%, 4 to 7%. But the company did absolutely bad, for sure. This is what you're getting back on this side. All right. But I hope this video was helpful. If you have any questions, you can reach us at livingequity.org or thompsoninsure.com and schedule an appointment and a wealth protection consultation. It takes about 15-20 minutes to kind of do a little filler to see where you're at, see what we can do to help. And if we can help, we definitely would love to do so. And if you're also interested in our debt elimination, recapture, reallocate strategy, you can also schedule a consultation there. All right. Well, I hope you enjoyed this video. Take care.